You're listening to the Seed to Exit podcast with your host, Reese Keck. Here you'll learn from startup executives, founders, investors, and industry experts. You'll learn from the best about building amazing products, scaling companies, raising capital, hiring the right people, and more. Subscribe and listen in for new episodes and enjoy the show.
Jordan, welcome on. Excited to have you.
Thanks for having me.
So I'm actually really excited to talk to you. Tusk has a really unique investment model. And so accordingly, I think this is going to make for a really unique conversation. You know, at surface level, Tusk invests in highly regulated markets, but I'm just curious, what does that actually mean in practice?
Yeah, so as you mentioned, our focus is to invest in companies that are operating in highly regulated markets. That it includes companies that are, so if you think more traditionally, kind of healthcare, financial services, transportation, energy, those are our core regulated industries. Our thesis goes a little bit beyond that, and that is, those are really interesting for us to invest in. Those areas, if you look at our portfolio, we're quite heavily invested in those spaces. Perhaps more importantly, the thesis is built around kind of a core theme, and that's that regulation always lags innovation. And so that the most transformative companies that are going to be built and have been built ultimately, once they become relevant, they become regulated. That's what regulators do. They exist to protect consumers and to protect people that are impacting consumers. So in essence, companies that like your Uber, your Airbnb, your Coinbases, of the world, they were in a regulatory gray area, and that's what makes those areas really exciting for us to invest in. So it's not just highly regulated existing markets; it's new and emerging verticals where there are no regulatory frameworks that currently exist.
Interesting. Yeah. Well, it's funny because as you were saying that, my mind immediately went to crypto, which obviously Tusk invested in Coinbase back in the day. So that completely makes sense. In terms of stage, do you have a particular stage you specialize in?
Every venture fund is going to have an opportunistic bucket, which is kind of a catch-all for, companies that you may have missed a little bit earlier, or maybe, a Series A co-invest. But our core focus tends to be at, post-product or post-revenue seed and Series A. So those are typically the areas that we make an initial investment in. We'll either lead or co-invest into those stages. And obviously we reserve capital to participate in follow-on rounds of financing to continue and support those portfolio companies. But I'd say that those two areas are kind of the bucket, and then we obviously have some opportunistic dollars that we'll allocate a small percentage of every fund to kind of outside of that core range.
Where did the investment thesis come from in terms of investing in these industries that are somewhat gray areas?
So my business partner, Bradley Tusk, his background is very different than mine. I've been a professional investor my entire career. Bradley's was very different. He started out as a political and regulatory strategist, helped Uber get licensed in New York City and the other largest markets across the U.S. And so that's been an area that he's been, helping to, support businesses in general, and then later on startups specifically in helping navigate those types of regulatory challenges and kind of. Whenever I was introduced to him, the concept around, this was over 10 years ago, and the idea of launching a new fund that didn't have a differentiated factor did not seem that compelling to either of us. So we kind of built this around a platform team that can, help founders execute against regulatory risks that no other firm should have, the capabilities that we do. And that was our kind of vision at the onset. And, we've been at it for about 10 years now. So.
I love that because the general concept of VC at this point is really, you have to value add to your portfolio companies in some way. And most funds are doing that in either helping introduce to customers, strategic guidance, helping hire. But yours is, I think, the first that has this sort of unique value add to it. So that's super interesting. When you mention the platform team, typically, what does that look like in terms of the support that you give to founders?
Yeah, so there, some of the kind of concepts that you just rattled off, those are kind of table stakes in our mind. Those are value add. That's just being a good board member. That's being a good investor. That's just areas that you're always going to be looking to as on the investing team side. To whether that's the guidance, specifically at the board level or just basically continued support for the founder. The platform is a dedicated separate team, and this is similar in structure to a lot of platform teams that are out there. I think the biggest difference is around kind of what areas they can jump in and help with, but also the size of the team. So our platform team is about 6 professionals that have a focus on either specific sectors of interest, or we also have a dedicated communications support person as well. So somebody who provides strategic guidance to portfolio companies on all things communications, in addition to somebody who focuses directly on healthcare, somebody who focuses specifically on fintechs, and then somebody who's a much broader generalist. Those are typically non-practicing lawyers that have been in the world of political and regulatory, either consulting or strategy or both for quite some time. So these are kind of seasoned professionals that some of which, or I'd say half of which at least, have worked in government or politics at some point in their careers.
I love that model. And when you're making investment decisions, of course, the whole value add of Tusk is helping navigate the regulatory environment. Do you also have some sort of expectation or is it a decision point in investment decisions on how familiar the founders or existing team already is with the regulatory environment, or does that not matter at all?
Absolutely. So it's a really good point. Basically, if you think about it, so the way that we view our kind of value proposition is for limited partners, so people who invest in our funds, and then also the founders that we invest in. So much more, forward to a limited partner is that, we believe that we have the ability to underwrite regulatory risk better than any other venture firm out there. That's not necessarily, it's a bigger deal. We just can hone in on what the real risks and likelihood of those happening are versus what we believe. And that we believe that gives us a strategic advantage from an investment acumen perspective. But perhaps more importantly, it's, helping founders execute against that risk. We also believe that we're picking, companies that have amazing teams, just like everyone else. And part of that is understanding the kind of the risks that are in front of you. So we don't believe that if the founder doesn't believe that regulatory is not a concern for them, and then we don't believe we really have a competitive advantage there. The idea is that, we'll be able to come in and win deals because of our specific value proposition. So if the founder's not really aware of it, that's something that, typically it's not gonna bode well for what we call the Tusk edge, right? Which is, here's this deal and we're going to underwrite this just like if you were, at a generalist firm. So we're looking at everything, the market size, the business model, the team, the traction, everything that you'd be looking at to underwrite a company as an early stage investor. And then we have, a section that is called the Tusk edge. And that is, what do we think that we can do directly that will help this company be successful? What is the level of edge that we think we have? The competitive dynamics within the round. Why do we think that we're best positioned to help this company be successful and win this competitive round of financing? And that's something that we document in every memo that we generate pre-investment. And then look, where the platform team can help out typically changes over kind of the life cycle of a startup. So whether it's a lot of times it's kind of proactive at the beginning, but if once a company becomes, successful and gains enough traction, and, our hope is that we can help, develop proactively with those founders and the regulatory agencies that are relevant, a moat around that business using regulation.
So you mentioned how the founders are thinking about regulation. And so I'm really interested because, obviously Bradley, as you mentioned, helped Uber get regulated. And in the beginning, Uber, it was sort of a free for all, right? There wasn't any regulation. They were just sort of moving into new markets or new cities and just more or less setting up shop. Anecdotally, in these specific gray area companies, how do founders usually think about regulation? Is it something they're very concerned about oftentimes? Is it, we just want to sidestep as much as we can? What is the general mindset of a founder?
It's really it's hard to say that to bucket everybody into a certain category. I will say that over the last 10 years, it has become pretty common for founders to at least be thinking about it. We're definitely not something that is not top of mind. And typically, look, for them to get into kind of our deal flow and our fund, like either an existing investor or we are hoping that either another founder or that founder or a current investor or somebody who has looked at the deal is saying, you know what, this looks and feels and smells like a deal that Tusk would do. That's because of these potential challenges down the road. And so I think that also, look, the companies that we've invested in already are kind of pretty obvious in terms of the regulatory challenges or opportunities that have been laid out for them. And I think that a lot of times founders will, they'll look and they'll hear about a company and they'll look up who the investors are and they'll kind of become aware of what we're doing through that. But yeah, look, I think that it really matters kind of the stage of the company as well. So there are times whenever If it's an early stage business and they know they're getting, a lot of questions around like what do regulations look like, that's going to be a flag for them. But I do want to hit back on kind of the comment that you made about the market expansion strategy with Uber specifically, because it's not necessarily just Uber. In the world of just tech investing, the vast majority of the regulations, crypto aside, some of the crypto regulations do happen here, but the vast focus is definitely at the state and local level, which is just kind of not necessarily where investors or founders tend to think that where a lot of the risk is. So if you think in healthcare, every single state has a different framework of which they regulate, medical professionals and business models in those states. We saw a tremendous amount of movement and risk and opportunity generated there during COVID, whenever cross-state licensures for different types of medical professionals were lifted temporarily. The ability to have conversations over telemedicine and behavioral health on Zoom, just like we're having a chat right now, became the primary mode of communication or those sessions, particularly on the behavioral health side. We saw a lot of changes in business model delivery that have occurred over the last few years. And a lot of that is navigating in a different level of, I guess, you're not going to necessarily behave the same way in one state as you will with another. Let's say a much more tech-friendly state versus California, for example. You're definitely going to move much more cautiously whenever you're launching a business in San Francisco than you are, if you're, let's say, in Texas. So I do think there are some examples, but that tends to change over time as well. So, market expansion is a big part of where we can drive value in the early stages, particularly around the go-to-market.
That's really interesting. I hadn't considered the complexities of each state. So I can imagine that we can go back to the Uber example again. One probably has to work with legal counsel in each and every state in order to ensure their compliance, or what does that look like in practice?
So early days compliance, no one knew what compliance was. So it was like, that was the cities and the states were trying to figure out what this new business model meant, what the risks were to obviously the riders, but also if there's unions involved. So the complexity does scale up and down based on the type of city that you're trying to launch in. But there's other really obvious examples as well. Obvious to me, but may not be for your listeners. So let's, I'm just thinking of two other portfolio companies that are in different sectors. So Lemonade, which is a started out as renters insurance, is now all property casualty insurance. So we were investors in Lemonade at the early stage and continue to invest into that company. And help them secure their first New York. So they wanted to change the business model they wanted to launch with was not to be an MGA, but to be an actual carrier. And so they had to convince New York Department of Financial Services to grant them a carrier license without meeting any sort of seasoning requirements, like being cash flow positive for 3 to 5 years. And then had to do that across every state they wanted to be operational in, convincing those departments of financial services to grant them that license. So that's one aspect. And then, FanDuel is another great example. You remember that the definition of being a game of skill, every single state had to pass it. Does that fit the bill for them? Or do they want to, continue to challenge it and say that, no, we're going to take the position that this is sports betting. This is pre-legalization of sports betting across the, many states that are out there today. This is before the repeal of PAPSA. But, similar in kind of the 50 state map and kind of where you're going to launch next, being kind of more strategic in terms of thinking that through from a business model perspective and a business opportunity set married with the regulatory risk of launching there.
Super interesting. I want to go back a little bit to the beginning of your career. So as you mentioned, you've been an investor essentially your whole career, and originally you were in institutional investment management over at Blackstone on the venture portfolio. I'm just curious, what was the transition like from moving from a traditional investment management where, you can model returns and you generally have some degree of certainty, but then moving to venture where it's much more of a, not to say a dice roll, but call it an educated investment or an educated guess?
Yeah, so I started out way before then, in investment banking, like many people did, at Morgan Stanley, and then moved to the buy side at AllianceBernstein, where I was in institutional sales and trading. And as you're mentioning there, that's a very different type of investment strategy. It's one where that shop is quite large at this point, so there's it's public market everything. So you're talking about public equities, and you're talking about fixed income as well. So but it is, as you're saying, it's a much more, that is a very different investment strategy, a lot more dollars behind it. And I'd say, look, not to call out the obvious, but there are a lot of great investors. Let's just make the comparison between a hedge fund and working in PE or venture. But
Sure.
venture capital is, let's just say, one of the last capacity constrained asset classes. I can't just hit a buy on a buy button and just buy up shares because I think it's a great idea. I have to go convince a founder to let me lead their Series A. There's only one Series A lead. There always is only one, or unless it's a co-leading scenario. So we need to go, and we're getting pitched by actually a number of companies, but the companies that we're looking to invest in, that turns into a kind of a reverse, as we go and progress in further and further meetings and a round starts to come together, you start competing with other venture funds, and you need to convince that founder why you're best positioned to help them achieve success.
Yeah, and it's interesting that mindset because so oftentimes people think of, venture as the prize. Like we need to raise money. Oh my God, this is a huge milestone. We've raised this amount of money, which it is. But then at the same time, it's also very much, particularly for great businesses that have lots of people looking to invest in them. It's also very much then almost a turning of the tables, right?
Yeah, no, it's that's exactly right. So it's once a company, and this tends to happen sometimes earlier. It doesn't really tend to happen at the same stage of a company. There are companies that come out of the gates really, 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 that have really exciting founding teams, that have really exciting concepts that everyone, that it is still a very, as much as the industry has grown, it is still rather tight knit. It is, and so people do hear about really exciting rounds of financing that are coming together. More obviously, if longer the company has been around and they have the ability to kind of get into hyper growth, and you start to see that, when the later stage investors start to get really excited, let's call that at the Series B and later, those companies have been around and they're starting to get, they're definitely starting to get traction. They appear to have product market fit. By the time the B rolls around, they should definitely have it. And it becomes, a little bit in the value, the sell that those firms have, they're just different to what an early stage investor is going to be providing. We, as I mentioned earlier, we specifically look for post-product, post-revenue businesses, and that's because we don't think that our value proposition is materially better than some of these really like pre-seed and core seed funds that have a lot of product people that work there, founders that have since become investors that have taken many products and taken them from an idea to something that's alive in the market, that's generating revenue. We believe that our value proposition is much more tangible and realistic and achievable post product, meaning like there is a line of sight to how these regulations are going to pan out. It is not just an idea at that point. So it's something that I think that great investors have the ability to know where they're best at, and that's where they really focus.
Well, right. And you really can't even navigate the regulatory world for your product if you don't have a set product that you're actually working on building.
Exactly. And so that's something that, I feel like sometimes whenever founders are out there raising money, they kind of are just going through the motions. And I think this is part of a concept that a lot of people do talk about, and that is, founder VC fit, right? Is this the right investor to come in and with the right platform to drive material value for your company at that moment in time?
Absolutely. Yeah. I mean, it's a 7 to 10 year relationship. It's not just, taking money and running. Speaking of which, you and Bradley, your co-founder, you are coming up on 10 years of the fund. Just curious, how did you two meet? What made you decide to form the partnership?
Yeah, sure. So Bradley and I met. So I was at Blackstone at the time, doing early stage investing off the firm's balance sheet. Invested in a New York City based real estate tech company that basically the founder introduced Bradley and I together. And he was currently at that point in time, he was dealing with Uber in New York City. It was quite a mess with Mayor de Blasio, and it's become kind of an infamous story in the city. And I had been investing at Blackstone for several years, and it was not in my mind, the idea was never that I was going to stay there to do that. It's something that, look, they're amazing investors on the buyout side, and they've launched a growth strategy. It's just early stage investing is just not something that's in that firm's DNA. And regardless, even if it was, I had the itch and I wanted to go start something for myself. But it wasn't lost on me while I was at Blackstone that I'd probably get a bunch of people answering my emails because I'm emailing them from Blackstone.com. It's that's
Yep.
not that wasn't lost on me. And at that point in time, obvious to both Bradley and I that if you wanted to launch a new fund, you need to really be differentiated. You need to have a different strategy. Just coming out there and trying to compete as a generalist firm is not compelling. It was something that, and we've started this after that. We, not to say we're the first ones to go in and specialize, but to that, at that point, there were firms that were investing exclusively in fintech or exclusively in real estate technology or cybersecurity or healthcare. So they were sector focused funds, but there weren't too many firms that were out there that had a value proposition that spanned across multiple verticals and multiple stages, where we could be relevant in terms of that value add. And not just to the founders, but also to investors, prior investors that wanted to de-risk their businesses from on the regulatory side as well. So our first fund was really a proof of concept fund that we raised in 2016, where we just wanted to go and see if we could get into. We saw that we thought it made total sense, and our LP base at the time thought that made total sense, but we wanted to prove that out. And so I do view it as a proof of concept fund. It was really, really hard to raise, but we were able to go out there and invest in some of the most transformative companies that really came out of those vintages. So 2016 to 2016 into 2018. So that portfolio includes companies like Lemonade, FanDuel, Coinbase, Roman, some companies that have really gone on to really kind of transform the industries that they're in. And so yeah, that was enough for us to go out and raise a second fund that was materially larger, where we started leading deals out of that vehicle, and we've raised 4 funds since. So
Yeah, I mean, you've clearly hit quite a few home runs, so that's fantastic. I'm curious. I did not see anything when I was doing my research in terms of your portfolio companies for AI, and AI, particularly in the coming years, I think is going to have a huge amount of regulation associated with it. What are your thoughts on that space, and specifically from a regulatory perspective?
yeah, absolutely. So this is an area that we've been very prudent and methodical about deploying capital into. So it's one, like I mentioned before, around the Tusk edge. Whenever the generative AI buzz started to come on originally, that everybody's scratching their head, who's going to regulate this? It needs to be regulated. Do we have any faith or conviction that this is going to be figured out at the federal level anytime soon? And then we just watch this kind of unfold. And there are hundreds of current bills that are active right now across pretty much every single state, that don't have one clear line of thinking. There are some common threads, but it's and so waiting for that to take a little bit more shape was something that we wanted to do to inform our investment strategy. I think the second important part to hit on is that we're also, look, I mean, we make our edge is on the regulatory side, but it has to be a great business that we understand and we can underwrite. So a lot of those very early on businesses that were focused, let's call them infrastructure, AI infrastructure, whether it's the LLMs or not, we didn't feel like we had an advantage in diligencing those businesses or in being pitched those businesses. Those are very technology forward. They were typically being funded by the technical teams at various different firms, and we just didn't feel like we had an information or a deal flow advantage at that point. Now we're getting a little bit further on, and so every business, let's just say, is tech enabled. I think that is kind of where we are. All of our portfolio companies are leveraging AI in some form of their business operations. Whether it is a core part of their product, are they selling AI to somebody? And there are a few areas that we've been scratching and sniffing there, that we're very interested in, that meet certain changing demands from highly regulated markets that are very concerned about data being sent back to whether it's OpenAI or another model for training if it's coming from healthcare. There's a tremendous concern that personal health information is going to be there is no appetite for people to for hospital systems to send that information back to these models. So we are seeing some pretty interesting, whether that's on the small language model or edge computing space. That's an area that we have been scratching and sniffing around on the technical side. But otherwise, it's much more around looking at businesses that are either leveraging AI. If that is their core service offering, it's going to look more like a compliance platform, or data integrity, data security, things that are much more tangible from regulatory compliance perspective. if that is an AI first business, which is just less interesting to us. So look, I think that there are quite a few portfolio companies that definitely leverage AI as part of their core product and their core offering. Though we're definitely investing in those, but it's much more specific to the vertical use case.
That's fascinating. This is not obviously a politics show, but I think it's impossible not to talk about politics when we're talking about the regulatory environment. And you've even alluded to it a couple of times. In the immediate, I mean, how are you thinking about the upcoming election, and what strategies do you have depending on who ultimately comes out on top?
Our strategy should be battle tested regardless of who's in office. And so I think that that's something that, we really take very, very, it's an important part of the strategy. Look, at the end of the day, there were implications that we were a little bit concerned about when, we were looking at the original ticket. And some of the implications that would have potentially happened if, there was a continued decrease in excitement around Biden and people just didn't show up to vote. Yep. That would have impacted some down ticket, really important decisions around, that would impact the states specifically, as a byproduct of that general election. Here, look, at the end of the day, I don't think that as it comes down to impacting us and our investment strategy, don't really think that it's also hard to handicap what what they say they're going to do whenever they get in office and what they are going to do whenever they're in office. And so I think net, if you take it into consideration, who's best at the top of the ticket, and let's say what happens at the state and local level as well. Net, it doesn't really matter to us. We just need to understand what's coming and kind of how to help the companies navigate that. From the macro level, look, interest rates are driving, the tremendous amount of the macro in terms of the IPO window being reopening and exits happening again. However, I'd say probably the biggest implication of the election at one point was around, the likelihood of the chair of the FTC, changing hands. That would obviously happen if Donald Trump was elected. Now the consensus thinking is that will still happen regardless, even if Harris wins the election. So those are kind of the two bigger factors that we would think about at the presidential.
And then to build on that, and obviously, as you mentioned, when different parties come into power, changes are made in terms of who's in the particular seats, also just in terms of the level of regulation. Obviously, I'm going to paint with a broad brush here, but Democrats typically equal more, while Republicans equal less. So when you think about outcomes for Tusk in the general investing environment, do you find that, quote unquote, better in terms of your business advantage if there's more regulation at the state, local, federal level, or less, just because if there's more, it creates a bit of a moat, so to speak, but it's just harder to operate. What are your thoughts on that?
Yeah, I would say that for us specifically, where we become the most relevant is not necessarily more or less, it's just change. Changing regulatory schemes require like a reanalysis of what your strategy is and kind of how you want that to play out over the next few years. And it's something that is changing all the time as industries mature, as new politicians come into power and leave power. And I think so radical change that does happen is something that is where we believe that we are the most relevant in terms of our ability to underwrite deals in a way that other firms aren't, and also in helping founders kind of change their regulatory strategy and deal with either heightened or reduced regulatory scrutiny. So as you mentioned, in times of increased regulatory scrutiny, there's a huge opportunity to take a proactive approach and work with regulators to help kind of craft that regulatory mode. Obviously, if in a decreasing regulatory environment, how fast do you run, and are these short-term or temporary restrictions that are being lifted that probably will come back into effect, like during COVID and the example I used earlier around healthcare. You need to take a position on this is was the catalyst to remove this regulation around cross-state prescription of controlled substances. Is this going to be temporary, or is the DEA going to reinstate this after the exemption is over? And you need to have an opinion on those. So I do think it's much more about the change than it is about if there's more or less at that moment in time.
That makes sense. Change is the only constant, right? Obviously, we all love to talk about our wins, and you've of course had a lot of them with Lemonade, FanDuel, Coinbase. But obviously, there are some things that cannot be considered wins. So I'm just curious, what is the biggest learning lesson you've had, either just in founding or building Tusk, or from a particular investment?
Yeah, look, I think that learning from mistakes, and then you're not playing the game the way it's intended to be played. So it's just something I tell my 5-year-old daughter all the time. It's that if she's not falling, she's not playing hard enough. So it's something that you feel like you should always be learning, and I do. I take this in earnest, and I think that whenever I started, I've been in this industry for a long time now, so it's especially in the venture ecosystem, it just, where I'm like an old man at this point, right? So it's, but I do think what's really important is that as I've gone through my career and I've invested in many more companies and I've been lucky to see many more outcomes, you do realize that starts to impact your ability to kind of pattern match, which is really what you need to kind of focus on those biases that you have, because that all that you end up doing if you're not focusing on them is going out and just looking for companies that look and feel and smell like what worked several years ago. And timing is a huge deal. Sometimes an idea just wasn't the right time then, is the right time now. There are core lessons learned that you should never do again. That's separate from constantly going back and reevaluating your investment strategy for the appropriate, is this going to work in this environment? And I think that's something that, is a constant lesson learned, that, we're not doing our job right unless we're constantly going back and reevaluating our strategy and our approach and how we're staying competitive to win deals.
Love that perspective. Final question for you. What's the best piece of advice you would give to a founder that's operating in the environment that you specialize in?
It's hard to say, to give a founder specific advice with regards to this sector, or this, if they're going after a highly regulated market. I do think that there's just a tremendous amount of opportunity there. These are really hard business models to execute on for a reason, but the pie at the end of the race, it's a much larger prize that you're going after. And I do think that while it can be really, really difficult, and there's a lot of people that are going to say this is not possible, that is unfortunately the fact that regulators aren't necessarily as the smartest people in the room about what they're regulating. And so a lot of times, a lot of these founders don't realize that they are the subject matter experts, and they should really take the bull by the horns and use that as an opportunity to educate those regulators and become a thought leader in the space.
Love that. Yeah, it's funny that you say that, because I think we've probably all seen the videos of like Zuckerberg getting questioned in Congress from people that clearly have no idea even about how the basics of Facebook advertising works, and people are saying like, these are the folks who are supposed to regulate AI.
Oh yeah, and they're on TV. Think about the decisions that they're making whenever that's not.
Yep. All right. Well, Jordan, you've dropped a ton of knowledge. Thank you so much for coming on the show. I really appreciate it.
Thanks for having me.
Thanks for listening to Seed to Exit. If you enjoyed the episode, don't forget to subscribe, and we'll see you next time.